like to use whenever I'm going to trade options or just good old shares, buy low, sell high, whatever you want to call it. Catalyst plays, press releases, any headline that sends stocks skyrocketing or falling, I'm there for it if I feel like there's enough conviction from either buyers or sellers to jump in with them and ride the trend down or up and take advantage of that by shorting it, going long, or buying options, either or calls or puts. In this case, we're looking at Tesla. I'm looking at the 3 minute time frame. I have a MACD down here of, let me show you the values, 12, 26, and 4. You should have a MACD and you should be able to change the 7 or 9 to a 4. So once you have that, you have the exact same MACD that I do. You're looking at the exact same time frame, 3 minutes, and you'll notice the first thing is when the stock crosses over down here, when that orange line crosses over the blue line, that's when you buy. So you would have bought here at open at 172, came up as high as 173, 174 almost, before coming down lower. And you notice when it came down lower, we got a MACD. We got to look at it. That orange line comes. You know, I'm gonna change that orange line. Can I change it? Because that's, I'm gonna change it to white, just for visibility purposes. Where's white? There we go. We know white is king. Am I right? No, that's a bad joke. That's a bad joke. Okay, so we'll change it to white. There's the change. Okay, so when that white line crosses under the blue line, guess what happens? Wow, it looks like it just came. It just dumped. You actually could have made money to the upside and then to the downside. And then you'll notice it crossed over the blue line again, and you could have made some money here to the upside. It went from 169 to 170. Whether you're buying calls or shares, the most important thing is to recognize A, what's the catalyst for the stock? Is it a positive catalyst or negative catalyst? Is it a good PR or bad PR? Bad headline or good headline? How are people reacting? Are they reacting by selling off or by buying in? Once you've identified whether the stock's more likely to go up or down, at that point it's about taking advantage of the MACD and waiting for the opportunities that present themselves. For example, if we look at the daily chart, you do want to look at the daily chart. If you're going to day trade Tesla, for example, if you zoom out on the daily chart, holy crap, is it just me or do we just have we just been going lower and lower? This stock used to be at 274, now it's down at 164, 171 is what it closed at on Friday. So it just keeps going lower over the long term. So what does that tell us, guys? If we're gonna ride the trend, if we're gonna go with the trend, then it would make sense to only short the stock, to only buy puts. And as I just showed you, you would want to do that when the cross under happens on that MACD. When you see that white line cross under the blue, that is when you want to buy the stock. Oops, I don't know what's going on here at this point. I think I'm jumping around. Okay, let me just move around here. There we go. Okay. So when that happens, in that case, because we know that the daily trend is to the downside, we should only look to buy puts or short the stock when the white line crosses the blue line. And so you wouldn't want to buy here. Why would you buy here on the crossover when we're looking to make money to the downside? Because the overall trend on the higher time frame is that we're just falling over the long term. And you would have made more money going short here or buying puts, because look at this drop. It dropped from 172 to a low of 168, $4. Here it moved from 172.5 to 174. So $1.50. You actually would have made more money going the short side. And now the most important thing here is the stop loss. So what I like to do is when the cross under happens on the MACD or crossover, it doesn't matter. Let's just say you bought in here at market open, you saw the crossover and you're like, you know what, I'm going to buy calls regardless of the trend. I'm going to just buy calls. So you would have bought here. You would have set your stop loss. If you look at the volatility, this is very volatile. It kind of moves up and down like a dollar, sometimes two. So you bought around 172. You know it's a volatile stock. You would want to set a stop loss at around 1 170 170.50. So you bought in at, yeah, 172. So you would want to set a stop loss at about 170. Yeah, 170. Where is it? It's 171. There we go. Yeah, you would want to set a stop loss 171. And then to protect yourself, when you see it going up in your favor, that's when you want to move up your stop loss. That's what I like to do. I like to move up my stop loss to break even, and then from there, at least if I lose, I only lose like a couple of dollars, assuming you're playing one contract. Or sometimes you just break even. But in this case, you actually would have made money because it still kept going up and it closed up here at 173.56. And you actually could have taken profit there because that's a dollar move almost. And you would have made whatever, depending on whether it's shares or contracts, you would have made some money at least. So really, the most important thing, the one thing that I do when I'm day trading Tesla, or day trading just options on stocks in general, have that stop loss, expect to lose, but if it goes up in your favor, move it up to break even. Now the stop loss is pretty wide because of the volatility that Tesla brings. But if we look at a stock like, let's say, QQQ, you'll notice one thing. Oh, that's the wrong one. QQQ. You'll notice one thing about QQQ is it's not as volatile. It's not jumping up and down a dollar or two at a time. Instead, oops, there we go. That's what I was looking for. Instead, this stock moves up and down like 50 cents, about 50 cents a candle. So that's a lot less volatile. Think about that for a second. Tesla moves up and down like a dollar or two at a time per candle. This one only moves around 50 to 60 cents per candle. So the volatility is almost, it's a lot less. If you don't want to trade something too volatile, definitely stick to something like QQQ or SPY. And the strategy doesn't really change. It's still the same thing. You look to buy on the crossover in the MACD, and then you look to go short on the cross under. So you would have bought around here and shorted it, and you would have made money because it came down. Here, you could have gone long on the crossover, and at open, you bought your calls, and it went up in your favor. And the stop loss, you would have moved it up. It's the same story. Nothing changes. The story is the same. The one thing that does change is the time frame, because some stocks are much more volatile than Tesla and QQQ put together. So a stock that's super volatile like Nvidia, which can move up and down like $8, $16, $30 in one day, that is probably the most dangerous stock to trade as a beginner. But for something like Nvidia that's very volatile, you want to use probably a higher time frame because of how much volatility this stock brings to the. Look at this choppiness on the MACD. Like that's, you really would want to use either a 5 minute or possibly even something a little higher to get a much more clear, just to avoid the choppiness, because choppiness it'll kill you. Choppiness with, if you're trading using this strategy, choppiness is your enemy. It's your enemy because you will get so many signals down here, and you'll be buying and selling, and you're just gonna get completely screwed. And it's hard to identify choppy days like that. So what the one rule that I have is if I take two day trades, and I get chopped on both of those trades, I'm done for the day. I stick to that rule because usually if it starts going choppy, then I'm gonna just take too many losses that are unnecessary. I'll take the two losses and move on and just trade another day. Because usually we have a trend. Like here's the trend here on Nvidia. It's going down lower. It's going down lower. That whole day was it just kept falling, and you would have made money that day going short. But if it's a choppy day, it's just gonna go sideways and it's just gonna chop. You're just gonna get completely. You're literally gonna get chopped, literally. Now here we trended to the upside. Where is it? I just missed. Look at this. Look at this day. We just kept going up. So if it's not a trending day, more than likely you get chopped up, you lose money, and then you kind of just you move on. You take your two losses because you got chopped, and you move on. You'll recognize this more as you get more experience. It's easy for me to say this. There's definitely some day trading videos that I've done. I think you can search them. Just look up day trading live shade trades, and you can see me just day trade live. and me going through the step by step and what I'm thinking as the candles are printing. But it's really boring. I don't really day trade as often as I used to. Now I just stick to good old swing trading because you just look at a chart, you buy in where it makes sense, and you kind of just hold, and you don't have to watch candles print all day. That's pretty boring for me. But I do day trade if there's a setup somewhere. If I think today's going to be a trend day, I will buy those calls and hold them till end of day, or I will just flip it here using the MACD down here. That's another strategy, by the way. If you think the stock's going to close green, then obviously you want to bet on calls because you think it's going to close green. You think it's going to go higher. So at that point, at market open, you buy your calls and you just hold it till end of day, and boom, you would have made money here because you would have bought at around 874. This thing went to 907. That's almost a $30 move, about a $30 move right there. And you bet that it was going to go up. Now, if you had bet that it was going to go down, you would have lost a lot of money. But that's a little more risky. Don't do that. You really have to do your due diligence and look at the charts. You really have to dig deep if you're gonna trade like that. If you're gonna bet to one side and just hold it till end of day, and then close the position before market close. That's a whole nother thing. That is it for the video, guys. Again, the big takeaway is the more volatile the stock, you want to use a higher time frame. The less volatile, you can use something like the 3 minute. I don't think you want to use the 1 minute. Not too, meh, maybe, but stick to the 3 minute. 3 minute, 5 minute, and possibly higher if it's more volatile. So always look to see how volatile it is. Always set your stop loss underneath the candle that you bought in at. If there's any rule that you want to follow, it's buy in on the crossover or cross under and set your stop loss underneath that candle. So if you bought here at 174, well, this candle closed in your favor at 881. You would have set your stop loss down here. You would have moved it up to break even, and you would have gotten stopped out, or you would have taken profits. I mean, we can go on and on. This is a lot more complicated because Nvidia is just so volatile. But the biggest takeaway is you buy on the crossover, you short on the cross under, you set your stop loss, you move your stop loss up to protect your funds. And if you're wrong, you're wrong. You take the loss and you take a small loss. And every now and then you will be wrong. You will take a bigger loss. But as long as you're protecting yourself, you'll be fine. Too many people, they buy calls or puts, don't set a stop loss, and they just hope, and then they blow up their account. It happens. Just look at Wall Street bets.